Let's get to Bob Pisani with today's ETF Edge. Bob?
Good to see you, Scotty. Investors are in love with their 4% plus bond yields, but is that a thing of the past? Will investors flee to stocks as yields drop? Let's talk to two big bond ETF authorities. Joanna Gallegos is co-founder of ETF firm BondBloxx. Jerome Schneider is PIMCO managing director and manager of the PIMCO Active Bond ETF, one of the biggest funds in the world. Joanna, you're telling clients they should increase their allocation to fixed income. Why? What specific areas of fixed income do you see opportunities?
Yeah, well, on a day like today, I think it brings fixed income into focus, especially rates and also credit. And so we're recommending clients consider moving out a little bit on the Treasury curve, somewhere in the 2, 3, 5-year space. And then also high-quality credit is one of our top recommendations. You can also increase a little bit of duration in that high-quality credit and pick up great yield and great performance without any incremental default risk.
How about high yield?
We love high yield at BondBloxx, and we'll talk more about that.
Was the yield game over? I mean, can you still get yields north of 4% in bonds and still stay in the higher quality end of the spectrum?
Absolutely, yeah. You're still. If you move into some of the credit exposures that we'll talk about, that's absolutely possible.
Jerome, I want to turn to you. You manage one of the largest actively managed bond ETFs in the world. That's the PIMCO Active Bond ETF, BOND. How much will the Fed cut in September? Let's get that out of the way. And what are you doing now in your actively managed funds? What are you moving around, if anything?
Yeah, there's two main pieces of information here. Number one, that the Fed has become sufficiently confident that they're going to begin that process, and that has one impact to the market. Secondly, the market itself is reorienting itself to get closer to that neutral rate of 3% over the medium term, and so rates have rallied based upon that premise. There's two main premises to take away from this, Bob. Number one, simply that investors need to get cash out of cash, move out of money market funds as those front-end yields begin to move lower and benchmark rates move lower based upon the Federal Reserve. And the second one is what we're seeing today is diversify into underallocations of fixed income. Provide that ballast, provide that income, and provide that total return to investors that is going to happen over time. So the premise of actually how the sequencing happens of those rate cuts is slightly less important than maintaining diversity, being the upper echelons of higher quality spread product and finding opportunities there. And you'll ultimately find yourself with a pretty nice ballast to the volatility we're witnessing over the past few trading sessions.
I want to go back to your comment about money market funds. We still have north of $6 trillion in money market funds, $6 trillion, and that money has been astonishingly sticky. The viewers love their 4+ yield on money markets. Will that money stay there now that yields are heading lower, or will it find someplace else to go?
Well, the vast preponderance of it is actually not risk-seeking, and I think that's one thing to take away, that you'll probably only see 10 to 15% of those money market funds actually move out. But there is a point here, is that the yields that people have really embraced over the past year are going to quickly erode. And in that process, the time is now to move out of cash, to cash out of your cash, and to find better opportunities for total return through diversified portfolios of fixed income. Look to places like asset-backed securities, agency mortgages, supplement that duration, that interest rate component, with some potential for price appreciation in bonds. As rates have moved lower, we're already beginning to see that over the past few trading sessions. But as we get closer to that neutral rate over that medium term, to that 3% destination for the Federal Reserve, there's some more price appreciation on the horizon. And that's why we want to urge investors, particularly those who are underweight fixed income, to begin to think about better ways to provide total return to their total portfolios amidst the risk-off situations we're seeing.
Okay, Joanna and Jerome are going to have a lot more on where bonds fit into your portfolio this fall, coming up at 1:10 p.m. Eastern Time on ETF Edge. We'll talk about treasuries, money market, corporates, and high yield. That's etfedge.cnbc.com. Scott, back to you.
Bob, thank you. That's Bob Pisani. Hope you watch ETF Edge coming up top of the hour.